Good morning, everyone, and welcome to the Ankerstar Wealth Market Update. I'm your host, Allison Ankerstar, and today we'll be talking about the abysmal Netflix earnings report, Lululemon's growth plan, and the gigantic drop in the mortgage demand. But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. Netflix whiffed earnings last night and shares are down over 25% overnight. Time to buy or time to bail on Netflix stock?
Good morning, Allison, and welcome everyone. A couple of folks before we get started have asked about the shoulder. Go and get the for those who didn't know, to have shoulder surgery. I don't not have the sling on this morning like you've seen in the past couple videos. Go in and get the stitches out today. So pretty excited about that. And then off on to physical therapy starting next week. So anyhow, just a quick shoulder update. But back to the question at hand. Allison asked, what's going on with Netflix? It's all over the news this morning. It was a debacle last night. And of course, everybody's downgrading the stock. It is completely time to bail, but let's talk about why. Shares are down 27%. Wave of downgrades. I'm looking for the exact number of subscribers. It showed the first subscriber loss in 10 years. So that's a pretty big deal for a, huge household name to have a drop in subscribers. And they said that they lost they estimate that 100 million people or some crazy number are sharing their passwords outside of their own family. And they swear a crackdown is coming. Well, crackdowns always kind of, suck, if you will, for a company to come out there, price raises, anytime they raise their price or do anything like that. So I don't know. I would have to say that Netflix was perfect for the time that, it took over for Blockbuster, which was a household name. Prior to that, it was the must-have kind of, stock or membership out there at least. And then, replaced by Netflix, CDs in the mail. That was kind of crazy. Innovative idea. And then now you have this. So when you look at this chart, all the way up at 650, it's down to 251. In summary there, Allison, completely time to bail on Netflix. They're not going anywhere, but there's just really not much catalyst for this to go higher in the highly competitive content category.
Next, Lululemon announced several growth incentives this morning. Is ticker Lulu a buy, sell, or hold?
Lulu is another great American brand that, popped on the scene. I don't know how many years ago it was, but it came out and initially kind of yoga, if you will, fairly focused on females instead of males. But it has really continued to grow over time. If you've been in the Lulu stores, they're pretty well done. It's luxury merchandise, if you will, because you're paying a premium if you go into Lulu for sure. But you're also getting quality gear. And of course, workout gear does take a toll over time, but Lululemon stuff just does last. So where's the growth opportunity? It's in men, honestly. As far as now, they're you can see the headline there, targeting a even bigger men's business. I think there was a time when Lulu, men would not wear Lulu because that's, female stuff. But I think that ship has sailed. The most recent purchase I bought for swag for company stuff was all Lulu, including a jacket that I love. So I think honestly, it was really, Lulu made this huge move up in the stock years ago. And then it kind of reset here. We'll look at the 1-year chart, see if we can see that. Well, let's go to the 5-year. I think that's probably a better story here that we can kind of tell, move that up to the middle for you. So, back in 2017, been kind of a straight line up from 50 up to 450. That's a 9X. Drop down to 300, up to 400. I do have Lulu in the book. It's not something that everybody holds, but there's a few folks out there that like the luxury space and luxury retail in particular. When you get down here into the, PE ratio, you're not going to see anything you like, though. This is luxury. So you have to kind of throw out all of the traditional valuation metrics for a stock and say, you know what, Lulu can grow into this PE that they have by continuing to target men. Do I think it'll work? I do. I don't know if they can double their revenue or whatever the headline was, but I do think it's going to cause an increase in the stock. So if you want to pick up some Lulu, I think there's still some more upside here, more upside than downside from its current price at around $409.
Last, mortgage demand has dropped about half from a year ago. What does this mean for the housing industry?
Well, we keep coming back to the, interest rates, what inflation, interest rates, and mortgages in the housing market, and why. Well, there, and you could say if you tune in and listen to this show, it's about stocks. Well, it's not. It's about wealth building. And maybe I need to brand that more better, if you will. Excuse me, brand it better. But it's really about building wealth. And one of the primary means to build wealth is you get to a certain age or state in your life and you become a homeowner, and let that buy a home, stay in it for try a decade or so, if you will, and then let it appreciate. And if you buy in a good investment type home, meaning view it as an investment, buy it in a good location, good schools, even if you don't have kids. Good location for everybody, not necessarily for you, because you want to be able to turn around and sell it someday. And then, you take good care of it and it moves up in price. So it's one of the primary methods of building wealth over a lifetime is your own personal house. And then, of course, if you want to get into it as a business, you can get investment homes and rentals, or just keep your personal house, like I did a couple times. My Florida home, my Alaska home, kept those. I fully intend to keep this house as long as we can purchase our way into the next one without needing the equity we have in this home. So it's a great way to build wealth over time. So that's why this is so important. So backing that out. Okay, so run it back 24 months ago, before we had this big move up in inflation / housing. Money was free. It's down. 30-year mortgages were down below 3%. Honestly, if you didn't refi during that time, you're kind of foolish. I mean, you have to look at that in the mirror as a mistake if you did not, right? You have to own that one. You had plenty of time, no matter what's going on in your life. But yeah, now we're looking at 30-year interest rates over 5%. You can see in that top sentence there, increase from to 5.2% for your standard old 30-year fixed mortgage. So those are numbers from yesteryear. We haven't dealt with those in a while. But why I bring that up is, so the past 24 months, we've had this huge move up, and people tend to think, it's called recency bias. People tend to think that when things move up, they're going to continue to move up. Like I should buy into the Austin market now because it's going to continue to grow. Well, it is going to continue to grow. That part I agree with, but I would not, think that you're going to now turn around and get another 2 to 3x on your house, because that move has already been made. So how does the mortgage rate act upon a market? Well, even with cash buyers coming here from California, yep. Okay, they're going everywhere, right? They have a lot of money. They make a lot of money in California because the cost of living is higher, so they get paid more. They come to states like, or Austin, just, as one data point, where it's not quite as expensive to live, so they can get more, their money goes further out here. So the move makes sense from them from a personal perspective. And if you're paying cash, you don't care about the mortgage rate. But if you're a homeowner here in Austin, there's not an endless supply of cash buyers who are going to outbid you for your house, outbid each other, out for your house until the end of time. So the move has been made. I would think things will start to resemble something more normal going forward as interest rates stabilize here. So just remember, how far is the Fed moved interest rates? A quarter point. That's it. A quarter point. They're predicting to go up to 1.75%, maybe even higher this year. At a quarter point move, the 10-year has moved from under 3% to over 5%. So process that for a second. We have another one coming up in a couple weeks. It's going to be at least a quarter, maybe 50 basis points. There's even, Bullard is always on, whatever the extreme stance is, he one-ups it. So he was saying yesterday it might be a 75 basis point move to get inflation under control. If that happens, what are we going to be looking at, 6 or 7% in mortgage rates? I think we could be. And that's kind of crazy, right? So if that's the case, the housing market, mortgage companies are going to get hit hard. The housing market, I think, is going to slow / stagnate or even walk back in some of the less popular areas. So something to think about from your personal situation. And if you want to talk about it, call me. But yeah, I think now is kind of the time, if you're looking to get out of your big expensive home, pocket the cash and downsize. I think you would be smart to consider that sooner than later. So anyhow, Allison, great question there on mortgages, and that's my take on the mortgage demand.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.